Yes, our November read on producer price index up 0.8%, up 0.8%. That's hotter than expected. And if you remove food, energy, and trade, it is up 0.7, also hotter than expected. And if you just remove food and energy, it's up 0.7. So food and energy, 0.7. Food, energy, and trade up 0.7. Now, the year-over-year numbers up 9.6 on headline producer price index. That is a new record. And if we look at food and energy year over year, up 7.7, also a new record. And remember, these go back to 2010 on the year over year because they recalculate a little differently. So that's the most recent comp. And if we look at year over year, food, energy, and trade, up 6.9%, another record. So all the numbers are hotter than expected. And, of course, we should expect this to happen. We know transitory has been retired. We knew the consumer price index that we had last week was hot as well. But yet we continue to see the long duration, the long maturities, 10s, 20s, 30-year on the Treasury side. Well, their rates aren't as responsive as one would think. They're highly in negative territory in terms of inflation. But we do see the yield curve remaining very flat. We see the shorter maturities very responsive this week because we have the Fed meeting, and most likely the taper is going to be quickened and rates will rise quicker. And I think that's why the curve has been acting the way it has. Joe, back to you.
39-year, Rick, I did some math. Is that 1982? So we were coming down. We were coming down at that point. We had already peaked. So for us to hit new highs and say 40 years, 41-year high, 42, 50, 60, what are those numbers? What are we talking about? Is it 8%, 9%? What were those? You remember?
Yes, yeah. The actual interest rates back in those years were in the mid-teens. Mortgage rates, in the early 80s, 82, 83, were around 13.5% to 14.5%. You had a 30-year bond that was right in that vicinity. So, yes, we're a long way away from those areas. But also remember that in the 80s, we changed the way we look at houses and rent. And this is a big deal. Peter Bookfar writes about this all the time. Home equivalent rent. The problem is that even though rents have gone up and it is captured in some of these reports, the actual price of a house has gone up much more aggressively. So there are many aspects of measuring the data. And I'm not saying they're inaccurate. They're just different. But the feeling when you think that you have to look at things like college, health care, home equivalent rent, some of the things they have changed, and hedonic accounting, meaning you can't include the price of a car that's stripped down. You have to get your lane changed, your automatic brake. All these features really add to the price of a car. So all of this makes the cost of living much more expensive. It's just a matter of trying to handicap it to an apples-to-apples state. And that gets more and more difficult because the Bureau of Labor Statistics has really morphed how they make some of these calculations.
Yeah, I guess it could be worse. I just looked up the highest inflation rate in U.S. history, Rick. It was 29.78 back in 1778. So at 1917, 19.6%.
You know what? Yeah, it took a lot of money to buy those triangular hats back then. Yeah, I remember reading about that.
But it has averaged 3.25%. So we are double the average for the past since 1914. But that's all in perspective.
Well, this is going to be an interesting exercise, Joe, because many of us, and I think you and I included, there were many years where we said that the anomaly to inflation was the 70s and 80s, the high water mark that we always are most frightened of. That truly, outside of about a 15-year patch there, maybe even a bit less, interest rates historically are much lower. So we're going to change that perception this time around. And I also caution, there's so many difficult things to explain. But when I'm in a crowd, they're trying to talk about this, I try to explain that we unplugged the global economy. We literally unplugged the U.S. economy. And to think that we could unplug it, have it all go dark, and then plug it back in and not think we're going to experience some very strange activity. And I think the policies and the activity combined is just going to make these prices hot, hot, hot for a long time.
Steve Leisman joins us. Not double digits, Steve, but 9.6 on PPI. It's not far.
Yeah, you got to go back, Joe. I got to use the old methodology for the PPI, and it peaked at 19.8% was the number.
Ooh.
That it back in 1980, I believe it was. Hang on, I'm still calculating it. There it is. Yeah, it's like 1980 for that. That's where it gets.
Well,
but look, here's the problem. The problem is that
we're going to start fixing it today.
Yeah. You know, Joe, I'm kind of perplexed why they can't fix some of this. Honestly, the idea about unloading ships, I think we know how to do that. You know, get Santelli out there, take his jacket off, roll his sleeves up. We'll all join in. We'll all join in. I mean, unloading ships for you know, it seems a little crazy.
Dangerous,
but let me just tell you two things about this story here. One. It's not just the final demand. It's that you still have inflationary pressures in the pipeline here. Intermediate goods, unprocessed goods. So there's no sign that the pipeline of price increases is easing. So that's going to still, and just a reminder that this whole thing started with producer prices being on the increase, and then that bled over into consumer prices. So the idea is that there's more pressure to come. The other thing, again, service sector inflation. You've got quite a bit of that. So that's another issue. Why the 10-year is behaving the way it's behaved and not afraid of inflation, but instead more concerned about rate hikes, I'll leave that to Rick. But it's a puzzle that a lot of people I talk to still don't understand, that it seems like they're concerned the Fed is making a mistake by being too aggressive, not by raising rates.